do you think this breakout has real legs, meaning we're going to be in a different orbit this year than we were last year? Or do you suspect that this is more of a bear market rally that will get dragged back down into bear territory at some point?
Okay, let's look at the evidence. One thing I noted, there's again, one of the Northcasts I put out earlier this year was XVG. It's equal weight. It's a measure of the market in, not in terms of market cap, like the S&P 500. It's a market cap based index, right? So the big boys, Amazon, Apple, they have all this big influence on
Right.
the weight. But if an equal weight says, okay, here's all the stocks, put them all at the same price, and then see the move on a relative basis. In 2022, if you look at the internals throughout the year, it was terrible. It was weak the entire year, and equal weight was terrible. But then suddenly something shifted dramatically at the beginning of this year. And I posted this little video about how equal weight was getting towards the downtrend line, the downtrend that we had in place in the overall market since the beginning of last year. And all of a sudden it broke out, while the S&P hadn't broken out at all. It wasn't even at its trend line. And there was a character shift that said, okay, this is different than what we've seen in 2022. And the question was, is equal weight sending a signal, a leading signal? And we now have the answer. It did. It broke out. Then the S&P followed suit. And as it broke out, like the other example I mentioned earlier on this little rounding pattern on the S&P, the equal weight pulled back tested, didn't even get a full back test of the breakout of the downtrend, and then ripped higher even further. Okay, and S&P, Nasdaq, everything followed suit. So there was if you look at NIAT or new highs, new lows, that's a key indicator. New highs, new lows last year, total disaster on the floor. Couldn't get above 50%. It was just terrible. It just screamed to 1992, 93, 94 vertically. That's a market shift in behavior, in the internal picture of the market. Got to recognize it, got to respect it. And in fact, this vertical move is very much similar to what we've seen at major market lows before. Okay. It's dramatic on the chart. I'll send it to you. You see it. It's just very different. So I look at this and I have to say, okay, I have to respect that something's changed in the market. And for that to completely reverse would have to show again, a change in behavior. And in equal weight, if that were to roll over now and take the market with it, that would be maybe one of those signals. The second thing is these breakouts that we had of these downtrends. It's significant technically. And it's significant in the sense that, okay, now we've crossed over specific moving averages in the market. We've broken above these downtrend patterns. And yes, while we're getting overbought, the next test that's, I think, totally important for bulls and bears is if now you get a back test, for example, coming from overbought, if that back test holds like it did with equal weight a few weeks ago, then you can argue this has a lot of legs higher. And I'll make that case.
Can you just give us like what S&P level would you expect the back test to bounce off of if it does hold?
Okay, it depends on the time because it's a downtrend, so it keeps going low. Okay, but I'll just give you some rough numbers in the here and now as we're approaching CPI report this week, this coming week with OPEX. Okay, if we were to get a down move, you have confluence levels on moving averages. You got the weekly 5 EMA, which is around 40.12. You got the monthly 5 EMA about 4,010. Keep in mind, these are all moving because as price moves in index, it'll adjust these things. We got the daily 200 MA and a daily 50 MA in this like 39.30 to 39.50 area. You got the downtrend line in the 39.50 area. You also have an uptrend line from the October lows to the December lows. And ironically, and this is pure coincidence, I presume at this moment, but they're all interjecting with each other for February 16th. Don't ask me why. It may just mean absolutely nothing, but I just think it would be absolutely hilarious if we were to hit that at that point. And then obviously, that would be quite a move from 41.95 to 39.50. Again, I'm not predicting this. I'm just talking about the confluence that is there. If you were to hit that, we would no longer be overbought. Certainly not on a short-term basis. We would probably be pretty cooking oversold. And by the way, going back to sentiment, if you all of a sudden draw from 41.95 to 39.50, I'm just using those general numbers, all of a sudden you would see narrative shift very quickly, right? That's when all of a sudden everybody would become bearish again.
They'd start sweating again, yeah.
Yeah, everybody's sweating again, the recession's coming and doom and gloom. And fair enough, if you break below, I would say if you see a sustained break below those levels, then everything would have been invalidated, these breakouts, right? You would say, okay, this breakout was a failed breakout. And I'll give you one specific example, what is maybe supportive of that notion. Okay, and that is, if you look at markets in general on a long-term basis, levels of control, and I talked about this at the very beginning of the year, what did bears fail to accomplish in 2022? Going back to the controlled bear market aspect, failed to drop the S&P below the yearly 5 exponential moving average. You do not have an extended bear market unless the S&P actually drops below the yearly 5 EMA. 2000, 2008, that's when we had extended bear markets, drop below it, bottom fell out. In other years, you can go back 50, 60, 70 years. Many times you have a larger correction, shorter term bear market that ends at the yearly 5 EMA. It may dip below it into a year for a little bit, but closes above it. And then guess what? You got 2, 3, 4 years of bull market coming. Happen over and over and over again. The other thing bears fail to do, and this was why the October bottom was so critical, monthly 50 MA. Extended bear markets, you may have an initial drop, you may have a bounce above, and then you drop below it. It never dropped below it. That was the low. It was support. And it's in extended bull markets, when you have these dings into the monthly 50 MA and they hold as support, off to the races you go. So in this context, I think every bear needs to understand there has been no evidence in context of this controlled bear market that a real extended bear market has been accomplished, because these levels held. Now, the counter argument to this is, and this is why I'm watching as a pivot of control, put this out as well on Twitter, about the monthly 20 MA. I mean, it sounds also simplistic, but yes, sometimes markets follow very simple rules. That monthly 20 MA, which currently sits around 42.13, 42.30. I use it as a range because the confluence resistance there is the weekly 100 MA. They're both sitting in the same vicinity. And we got very close to it on this rally here in February. We got to 41.95. So really in a spitting distance. And like the monthly 50 MA, you can look at 30, 40 years of data. When the S&P is above the monthly 20 MA, it's in the bull phase. And every time it gets dinged at support, may dip below it temporarily during the month. You got to look at the monthly closing candle, closes the month above, it remains support in bull phases. in extended bear markets, and you go back to 2008, you go back to 2000, the counter rallies got to there and then rejected. And that's why this particular market phase is so interesting, because we got over the weekly 50 MA, which often also is lights out for bear market rallies. So that kind of says, okay, maybe it's over for bears.
Yeah, maybe this has got some momentum, some bullish momentum here.
But the monthly 20 MA, to me, is like the key measuring stick. And in 2008, it failed. In 2000, it failed. Now, in 2008, it was confluence with the daily 200 MA, which was resistant, hit it for one day, and then fell apart, right? This time, we're over the 200 MA clearly, as I pointed out. So now, the challenge is for bears to hold the monthly 20 MA, because if you get above it on the monthly close and then defend it as support on any retrace, lights out. That to me is the true, based on historical observation, that to me is the true dividing line between whether it's a new bull market or it's still a bear market. Because there's been a lot of talk that the bear market is over. It may well be, but I don't have the evidence of it yet. Okay, so if you close February above, let's say, call it 42.30, 42.50 if you want to be safe, and you sustain a move above it in March, and any corrective move from there retests that monthly 20 MA and holds support into close, then these bullish patterns that I have could well play out, and they can point to 4,300 and 4,400.